Stop looking at the stock market tickers. Stop listening to the soft landing speeches from the Federal Reserve. If you want to see the real crime scene of the next American collapse, you need to look up. Right now, in every major city across America, there are ghost towers, massive steel and glass monuments to a bygone era, standing empty, silent, and decaying. But here is the terrifying part. On the books of your local bank, the bank where you keep your retirement savings, the bank you trust with your payroll, these worthless, empty shells are being marked as premium assets worth hundreds of millions of dollars. What if I told you that the banking system isn't just ignoring reality, but actively engineering a hallucination? What if the reason your grocery bill is skyrocketing and your savings are earning pennies is because the entire financial system is currently on life support, desperately trying to plug a $1.5 trillion black hole that nobody is talking about? This isn't just a market correction. This is a cover-up. We are witnessing the quietest, deadliest bank run in history, and it is not happening at the teller window. It is happening in the shadowy backrooms of commercial real estate accounting. I am going to show you the unfiltered truth about the extend and pretend scheme that is holding the U.S. economy hostage. Before we dive into the belly of the beast, I want to know, where are you watching from, and have you noticed for lease signs taking over your town? Let me know in the comments. And if you're ready for the truth the mainstream media is too scared to print, hit that subscribe button right now. Let us peel back the curtain.
To understand the catastrophe staring us in the face today, we have to go back to the 1980s. Does anyone remember the savings and loan crisis? It was a time of reckless greed, deregulation, and ultimately a collapse that cost the American taxpayer billions. Back then, thrifts, or S&Ls, were boring institutions. They took your deposits and gave out mortgages. Safe, simple, until the interest rates spiked. Suddenly, the money they had to pay to you, the depositor, was higher than the money they were making on old fixed-rate mortgages. They were technically insolvent. They were dead banks walking. So what did the government do? Did they shut them down? No, they deregulated. They allowed these zombie banks to gamble with your federally insured deposits in high-risk commercial real estate projects to try and earn their way out of the hole. Sound familiar? Fast forward to 2008, the global financial crisis. We were told it was about irresponsible homeowners buying houses they could not afford. That was the narrative. But the mechanics were about bundling garbage debt into shiny packages called mortgage-backed securities and selling them as AAA gold to pension funds. When the underlying asset, the house, dropped in value, the leverage blew up the world. Now, look at 2024 and 2025. We are standing on the precipice of a crisis that combines the worst elements of the 1980s S&L disaster with the explosive leverage of 2008. But this time, it is not the homeowner who is delinquent. It is the corporate landlord. It is the private equity firm. It is the owners of the massive office parks, the shopping malls, and the luxury apartment complexes. Here is the setup. For a decade, interest rates were at zero. Money was free. Developers went on a binge, building office towers and buying commercial properties at inflated, astronomical valuations. They borrowed billions from small and mid-sized regional banks, the very banks that form the backbone of the American economy. Then, two things happened simultaneously. First, the pandemic changed the world. Work from home became permanent for millions. Office occupancy collapsed. Second, the Federal Reserve hiked interest rates at the fastest pace in 40 years. Suddenly, these building owners are holding assets that generate half the income they used to, but the cost to service their debt has doubled or tripled. In a sane world, these businesses would declare bankruptcy. The banks would seize the buildings, sell them at a loss, take the hit, and move on. That is how capitalism is supposed to work: creative destruction. But that is not what is happening. Instead, we are seeing a coordinated effort between regulators, banks, and borrowers to freeze time. They are looking at a building that was worth $100 million in 2019, which is now worth maybe $40 million, and they are refusing to write down the loss. Why? Because if the banks admitted the true value of these assets, hundreds, literally hundreds of American banks would be instantly insolvent. Their capital buffers would be wiped out overnight.
Sound familiar? It is 2008 all over again, but instead of subprime houses, it is subprime skyscrapers. And instead of Lehman Brothers, it is the bank down the street from your house. The official narrative is that the banking turmoil of early 2023, Silicon Valley Bank, Signature Bank, First Republic, was an isolated incident. They told you it was just bad management at a few quirky tech banks. They lied. Those failures were just the tremors before the earthquake. The systemic rot is in commercial real estate, or CRE. Small and regional banks hold nearly 70% of all commercial real estate loans in this country. They are exposed. They are vulnerable. And just like in the 1980s, they are gambling that if they just ignore the problem long enough, it will go away. Sound familiar? It is the definition of insanity. And you, the depositor, are the collateral damage waiting to happen. Now, you might be thinking, okay, the buildings are empty, the banks are hurting, but surely the regulators will step in. Surely the FDIC is watching. This is where the story takes a dark turn. This is the twist that makes this worse than incompetence. This is collusion. The mechanism allowing this charade to continue is not just a handshake deal. It is a specific regulatory loophole that has been weaponized against the public. It is a strategy formally known in the industry as extend and pretend, but the technical term is even more insidious: loan modification without classification. Here's the secret they do not want you to know. The regulators have implicitly authorized banks to not report these loans as delinquent, as long as the borrower makes a token payment or the terms are slightly adjusted. They are allowing banks to treat a loan that is effectively defaulted as current and performing. They are cooking the books, and the government is supplying the gas for the stove. But who is the architect of this? Who is the silent partner ensuring the music keeps playing while the ship sinks? It is not just the Federal Reserve. It is the appraisal industry itself, captured by the very banks they are supposed to audit. We are seeing a phenomenon I call the Mark-to-Fantasy Valuation Model. In 2008, the villains were the credit rating agencies, who stamped AAA on garbage. Today, The villains are the commercial appraisers and the bank audit committees who are looking at a vacant office building in downtown San Francisco, a building that could not find a buyer at a 70% discount, and keeping it on the books at its 2019 value. Why would they do this? Because if they market to market, if they admit the real price, the shadow banking leverage collapses. You see, these loans aren't just sitting in a vault. Many of them are bundled, sliced and diced into CLOs, collateralized loan obligations, and CMBS, commercial mortgage-backed securities. These securities are used as collateral in the repo market, the plumbing of the global financial system.
Deep, authoritative American male voice. Gritty, investigative journalism. Cynical and disgusted tone. Low pitch. Gravitas. Sharp emphasis on verbs. Significant pauses after rhetorical questions. Accusing tone when talking about banks. No happy or upbeat tone. If the value of the collateral drops, the repo market calls for more cash, a margin call. If the banks do not have the cash, the system freezes. So to prevent a total systemic freeze, everyone has agreed to lie. They have agreed to pretend the emperor is fully clothed. But there is a receipt. There is a paper trail that proves this fraud is happening right now. And when I tell you the sheer scale of the debt that is coming due in the next 24 months, your jaw will hit the floor. You won't believe the name of the entities holding the bag this time. It is not just the banks. It is your pension fund. It is your insurance company. And the receipt is wilder than you think. Let us strip away the jargon and look at the terrifying mechanics of this machine. We need to talk about the maturity wall. Commercial real estate loans are not like your 30-year fixed home mortgage. They are short-term loans, usually 5 to 10 years. At the end of that term, the borrower doesn't pay off the house. They have a massive balloon payment. They usually pay this by getting a new loan, refinancing. Here is the math that spells disaster. Number 1. The $1.5 trillion time bomb. According to data from TREP and other analytics firms, approximately $1.5 trillion in commercial real estate debt is maturing by the end of 2025. That is a trillion with a T. This is a massive wave of debt that must be refinanced. Number 2, the rate shock. When these loans were taken out 5 or 10 years ago, interest rates were near zero. The interest rate on these loans was perhaps 3% or 4%. Today, to refinance that debt, the borrower is looking at rates of 7%, 8%, or even higher. Let us use a real-world example. Imagine a developer owns an office building. In 2019, the mortgage payment was $100,000 a month. The rent collected from tenants was $150,000. Life was good. They were making a profit. Today, because of the rate hike, the new mortgage payment to refinance would be $200,000 a month. But wait, half the tenants left because of remote work. So the rent collected is now only $75,000. Do the math. The building is losing $125,000 a month. It is a bleeding asset. It is financially radioactive. Number 3, the valuation collapse. Because the building is losing money, it is worth less, a lot less. In cities like San Francisco, Los Angeles, and even parts of New York, we're seeing office buildings sell for 40 to 70% less than they were bought for just a few years ago. A 70% drop is not a correction. That is a crash. That is a depression-level event for that asset class. So why haven't the banks collapsed yet? This is where the Mark-to-Fantasy and extend and pretend mechanics come in.
If the bank admits the building is worth 70% less, the loan they gave the developer is underwater. The bank has to record a massive loss. If they record that loss, their capital reserves drop below the legal limit. The regulators shut them down. The shareholders get wiped out. So the bank calls the developer. The developer says, "I cannot pay. I am going to mail you the keys." This is called jingle mail. The developer walks away. But the bank does not want the keys. They do not want to own a rotting office tower. So the bank says, "Wait, don't default. Let us pretend. We will extend your loan for 2 years. We will not make you pay the principal. Just pay us a little interest, whatever you can afford, and we will call this a performing loan." This creates zombie banks supporting zombie buildings. The illusion is maintained by moral hazard and parasitic finance. The executives at these banks are incentivized to keep the game going just long enough to collect their annual bonuses. They are stripping the equity out of the bank while the ship sinks, knowing full well that when the extend period ends, there is no more road left. But it gets deeper. Let us talk about the CMBS conduit fraud. Many of these loans were bundled into commercial mortgage-backed securities. These are bonds sold to investors. The structure of these bonds is complex, divided into tranches. The safest tranches get paid first, the risky ones get paid last. When a building loses 20% of its value, the risky investors get wiped out. When it loses 40%, the middle investors get wiped out. When it loses 70%, even the so-called safe investors, the pension funds, the insurance companies, take massive hits. To stop this panic, the entire system is colluding to freeze transactions. Transaction volume in commercial real estate has plummeted. Why? Because if you don't sell the building, you don't have to report the price. If there is no price, there is no loss. It's Schrodinger's real estate market. As long as you don't look in the box, the cat is both alive and dead. But we know the cat is dead.
Look at the vacancy rates. In some major metro areas, office vacancy is hovering near 20% to 25%. That is 1 in 4 offices empty. But the utilization rate, people actually swiping their badges to enter, is often below 50%. This is a structural shift in human behavior. It is not cyclical. Those jobs are not coming back to those cubicles. The banks are holding collateral that is obsolete. It is like holding a warehouse full of horse buggies in 1920 and insisting they are worth full price because people will eventually get tired of cars. It is a delusion. And here is the most dangerous part of the mechanism: the FDIC insurance fund. The Federal Deposit Insurance Corporation has a limited amount of money. It is meant to handle a few bank failures a year. It is not designed for a systemic collapse of the regional banking sector. By extending and pretending, the banks are effectively gambling with the FDIC's money. They are hoping interest rates drop miraculously or prices recover miraculously. If they do not, and they will not, the losses will be so large that they will wipe out the FDIC fund. And who backs the FDIC? You do, the taxpayer. Or, in a worse scenario, the bail-in laws triggered under the Dodd-Frank Act could allow banks to convert your deposits into equity to save the institution. They are essentially transferring the ownership of these worthless concrete shells from the reckless developers and the greedy bankers directly to the American public. You are buying these empty buildings, and you do not even know it. This is engineered collapse. They are managing the descent not to save the economy, but to save the elite asset holders while passing the ultimate bill to the working class. We are living on borrowed time. The modern financial system is faster, more interconnected, and more fragile than it was in 2008. When this dam breaks, when the pretend phase finally expires,
and reality comes crashing in, it will not happen over months. It will happen over days. Digital banking allows billions to flee a bank in seconds. We saw it with Silicon Valley Bank. The next crisis will be global, instant, and merciless. The tragedy here is not just financial, it's a tragedy of denial. We have built institutions that prioritize the illusion of stability over the truth of solvency. We have allowed a parasitic financial class to hollow out our cities and our economy, creating a facade of wealth built on a foundation of empty rooms and unpayable debts. If you're sitting there thinking, my bank is safe, or I don't own office buildings, this doesn't affect me, you are walking into the trap. When small businesses can't get loans because local banks are insolvent, jobs disappear. When tax revenues from commercial properties plummet, city services get cut, and crime rises. When the FDIC has to bail out the system, inflation eats your paycheck. This is your wake-up call. The 4 lease signs in your town are not just signs of a slow market, they are warning flags of a coming avalanche. Do not be the person who trusts the official press release. Do not be the person who believes the bankers when they say the system is sound. History has taught us one lesson. By the time they admit there is a crisis, it is already too late to get your money out. Are we wiser now? Or are we walking the same path as 2008, just wearing better suits and using more complex algorithms? I think you know the answer. We are building a community here of people who refuse to be blind to the truth. We are tracking the collapse in real time. If you found value in this deep dive, if you want to arm yourself with knowledge before the crash, you need to be subscribed. Share this video with someone who thinks the economy is doing fine. Be the skeptic. Be prepared. I am your host. Stay vigilant because the receipt is coming due and they want you to pay it.